Welcome to the Wells Fargo Securities Monthly Economic Outlook. I'm your host, Charlie Doherty, and with me is Wells Fargo Securities Senior Economist, Mark Vittner. Mark, so the economy continues to encounter a number of headwinds, ranging from intensifying inflation, widespread labor shortages, and overwhelmed supply chains. But through all of that turbulence, how is the economy holding up?
Well, it's holding up reasonably well. I mean, we're still seeing very strong job growth, and with strong job growth, we're getting strong income growth. Consumer spending seems to be holding up okay. I think that's where we're beginning to see some cracks from higher inflation, where consumers are pulling back from some purchases. Although, some of that's just tied to the lack of supply. People aren't buying cars because there's no cars to buy. But certainly the higher prices are beginning to put people off a little bit. And I think that a good part of the third quarter slowdown was tied to the flare up in inflation.
So, looking further ahead, when do you expect some of these headwinds to die down a little bit? What are the prospects for economic growth over the next few years?
Well, I think that there's a good chance that we're at peak supply chain woes right now, and that the supply chain situation will improve over the next 6 months. It certainly won't be over in 6 months. We're still going to have challenges with ships not being able to get into port, with shortages of truck drivers and tight warehouse capacity across the country. Those problems are likely to persist for the next couple of years at least, but they should be getting progressively less bad. And so the and inflationary pressures that are emanating from that part of the economy should begin to settle down by late spring, summer of next year. But that's only part of the problem. I mean, we've had a whole lot of stimulus that's been pumped into the economy. The Fed's going to begin to try to drain some of that, but you really can't remove it. I mean, we're going to be slowing the rate that we're adding new stimulus to the economy, not removing what's already been added there. And that's one of the reasons that supply shortages turn into higher inflation, is there's so much fuel out there in the economy to support spending even when prices go up.
Yeah, you mentioned inflation and price pressures are certainly heating up. So, what do you think about the outlook for inflation? There's been a lot of debate recently surrounding whether inflation right now is temporary or more long lasting in nature.
Yeah, and it gets back to what the Fed has been saying, where they use the word transitory. And transitory and temporary don't mean the same thing. I mean, we are seeing a bit of a transition from the very low inflation environment that we had prior to the pandemic to something that's going to be higher. But we're also transitioning with all the disruptions that came out of the pandemic, and it's going to make it kind of confusing in the interim. But we're likely to see that inflation is going to go to the mid to high single digits over the next few months, and there's some risk to the upside if we were to see natural gas prices spike further. For example, if we had an extremely cold winter in the United States or Europe, that would present some immediate upside risk to the inflation numbers. But it really wouldn't affect the longer term outlook, where we see inflation moderating over the next couple of years, and we see inflation coming back down toward the Fed's 2% target late in the forecast period, late in 2023, and there's probably upside risk to that forecast, but we're not on a path that's going to take us back to what we experienced in the late 1970s and the early 1980s.
So we have strong inflation, but we also have strong job growth. Now, you mentioned earlier that the Fed has announced that they're going to start tapering back their bond buying program. But what about interest rate policy? Do you think they're going to raise interest rates anytime soon?
Well, they're getting closer. Before the Fed raises interest rates, they need to stop their bond buying program. Right now, they're buying $120 billion net of Treasury securities and mortgage-backed securities, 80 billion of Treasuries, 40 billion of mortgage-backs, and they are going to start reducing that in mid-November by $15 billion in November and another $15 billion in December. And after that, they will reassess but most likely they will continue to reduce their securities purchases by $15 billion a month so that they will end their securities purchases by June of next year. That means that they could start raising rates as early as July. I doubt that they would do it that quickly. They probably want to reassess and see what the impact of reducing securities purchases is on the economy. The impact of monetary policy changes on the economy is long and variable. And so it would make sense that they would take a step back after they finish winding down their securities purchases and wait a couple of months at least before raising rates that first time. And I think that probably puts the first hike in September. And then they probably wait till we get past the midterm elections, go again into December. And we think they continue to raise rates in 2023 so that we get the federal funds rate back to a little bit above 1%.
Mark, thanks for joining us. And thank you all for tuning in. Please join us again next month as we discuss our latest economic outlook.